Canada's oil industry supports over 500,000 jobs, generates billions in tax revenue, and fuels nearly 30% of the country's export economy. Now imagine one major player suddenly pulling back production. That's exactly what just happened. Imperial has cut off a significant portion of its oil output, and the ripple effects could hit everything from gas prices to government stability. The timing? Highly sensitive. The reaction? Intense. And the political fallout? Potentially explosive. This isn't just about barrels of oil. It's about power, policy, and pressure. Markets reacted, analysts scrambled, and reports suggest tensions are rising at the highest levels of leadership. Why would a company make a move this bold right now? When inflation is already squeezing households and energy demand remains critical, is this a strategic play or a warning sign of something much bigger brewing beneath the surface? In this video, we're breaking down the 10 real reasons behind this shocking decision and what it means for your job, your wallet, and Canada's economic future. Number 1, regulatory pressure. Is reaching a breaking point behind the headlines and political drama. One of the biggest forces driving this production cut is regulatory pressure, and it's been building for years. Canada has some of the most ambitious climate targets in the world, with firm commitments to reduce emissions significantly over the next decade. That means stricter environmental rules, tighter reporting requirements, and rising compliance costs for companies operating in carbon-intensive industries like oil sands production. For a company like Imperial, every new regulation doesn't just mean paperwork. It means higher operating expenses, potential project delays, and reduced flexibility. Carbon pricing systems are designed to make high emissions more expensive. While that supports environmental goals, it also reshapes corporate decision-making. When costs rise and profit margins narrow, production adjustments often follow. In simple terms, if it becomes more expensive to produce each barrel, companies may choose to produce fewer barrels. And this isn't happening in a vacuum. Investors are watching. Global markets are watching. Policymakers are watching. When regulations tighten quickly, businesses sometimes hit pause. Not out of panic, but out of strategy. Cutting production can be a way to reassess long-term viability under new rules. John, now think about what that means for everyday Canadians. If regulatory costs push production lower, supply tightens. When supply tightens, prices can climb. That impacts fuel costs, transportation expenses, grocery prices, and even heating bills. So while this decision may look like a corporate maneuver on the surface, it connects directly to household budgets across the country. The real question is, are these regulations accelerating a transition or accelerating economic tension? If this breakdown gave you a clearer picture, drop your honest take in the comments. Was this move justified or reckless? We put serious effort into unpacking these stories for you, so if you value deep, no-nonsense analysis, subscribe. It's just one click, but it helps us more than you know. Number 2, carbon taxes are quietly reshaping the industry. If regulatory pressure is the storm cloud, then carbon taxes are the lightning strike. Over the past several years, Canada's carbon pricing system has steadily increased the cost of emitting greenhouse gases. The idea is simple. Make pollution more expensive so companies are encouraged to innovate and reduce emissions. But for oil producers, especially those operating in the oil sands, this policy carries massive financial weight. When oil extraction, particularly from oil sands, is energy intensive. That means higher emissions per barrel compared to some conventional sources. As carbon prices rise year after year, the cost to produce each barrel climbs alongside them. And when production costs rise too high, companies are forced to make tough decisions. Do they absorb the hit and accept thinner profit margins? Or do they scale back production to protect long-term financial stability? For a corporation accountable to shareholders, the answer often leans toward protecting margins. Cutting output can stabilize costs and reduce exposure to escalating carbon fees. It's not always dramatic. Sometimes it's calculated and strategic, but the impact is very real. Now bring this closer to home. When production slows, supply tightens. When supply tightens, markets react. That reaction can show up at the gas pump, in delivery costs, and eventually in the price of everyday essentials. So while carbon taxes are designed to drive environmental progress, They also create economic ripple effects that affect workers, consumers, and entire provinces. The big question becomes, can Canada balance environmental ambition with economic resilience? Or will one continue to strain the other? We spend hours breaking down complex stories so you get clear, straight facts. Now we want to hear from you. Are carbon taxes helping Canada move forward or pushing industries away? And drop your thoughts below. And if you appreciate the effort behind this content, hit subscribe. It's one click that keeps this channel growing. Number 3. Global oil demand is becoming unpredictable. For decades, oil demand followed a fairly predictable path, growing steadily as economies expanded and populations increased. But today, that stability is fading. Global oil demand has become increasingly unpredictable, and that uncertainty is forcing major producers to rethink their strategies. Around the world, governments are accelerating the shift toward renewable energy. Electric vehicles are becoming more common. Honeycomb and corporations are setting aggressive net zero targets. Just 5 years ago, electric cars felt like a niche market. Now they're parked in suburban driveways, city streets, and corporate fleets. Every EV sold represents future fuel demand that may never materialize. That shift might seem gradual, but when scaled globally, it creates serious long-term forecasting challenges for oil companies. On top of that, economic slowdowns in major markets like China, Europe, or the United States can quickly weaken oil consumption. When growth stalls, energy demand often softens. Add geopolitical tensions, trade disputes, and fluctuating currency values into the mix, and suddenly predicting demand becomes incredibly complex. For a company like Imperial, producing at full throttle in an uncertain demand environment can be risky. Oversupply drives prices down. Lower prices shrink profits. Cutting production, on the other hand, can be a defensive move, a way to avoid flooding a market that may not absorb the extra barrels. Now think about what this means for Canada. If global demand weakens unexpectedly, it can affect exports, government revenues, and jobs tied to the energy sector. This isn't just about international trends. It's about how global shifts trickle down to local communities. In a world where energy transitions are accelerating, stability is no longer guaranteed, and uncertainty changes everything. And we dig deep so you don't have to. Now tell us what you think. Is the world moving away from oil faster than we're ready for? Drop your perspective in the comments, and if you value this kind of analysis, tap subscribe. It's one simple click that helps us keep delivering. Number 4, infrastructure bottlenecks are limiting growth. Even if demand were strong and regulations manageable, there's another major constraint that often gets overlooked: infrastructure bottlenecks. Oil production doesn't exist in isolation. It depends on pipelines, rail systems, export terminals, and refining capacity. And when those systems reach their limits, production growth hits a wall. Canada has faced ongoing challenges with pipeline expansion. Major projects have been delayed, debated, and in some cases canceled after years of legal and political battles. When pipeline capacity is tight, producers can't efficiently move oil to domestic refineries or international markets. That creates a pricing problem. Canadian crude can end up selling at a discount compared to global benchmarks simply because it's harder to transport. Now imagine producing millions of barrels per day, but struggling to get them where they need to go. That mismatch can hurt profitability. Now, in some cases, companies may decide it makes more sense to scale back production rather than sell at discounted prices or rely on more expensive transportation methods like rail. For Imperial, cutting output may not just be about politics or policy. It may be about logistics. If the infrastructure isn't expanding at the same pace as production capacity, the math stops working. And when the math doesn't work, companies adjust. For everyday Canadians, our infrastructure constraints can mean regional price disparities and economic slowdowns in energy-heavy provinces. Workers feel it, local businesses feel it, provincial budgets feel it. The bigger issue, infrastructure debates often take years to resolve, but corporate decisions happen much faster. And when those timelines collide, production cuts can become the immediate solution. We invest serious time connecting the dots behind these headlines. Now it's your turn. Do you think pipeline delays are hurting Canada's energy future? Share your thoughts below. And if you respect the effort behind this research, hit subscribe. One click goes a long way in supporting this channel. Number 5. Investor pressure and ESG rules are changing corporate decisions. Another powerful force behind this production cut isn't coming from politicians or regulators, it's coming from investors. Over the past decade, global financial institutions have dramatically shifted their priorities. Large pension funds, asset managers, and banks are increasingly focused on ESG standards, environmental, social, and governance metrics, when deciding where to put their money. For oil companies, so this shift matters more than most people realize. Access to capital is the lifeblood of large-scale energy projects. Drilling operations, facility upgrades, and expansion plans require billions in financing. If investors grow cautious about carbon-heavy industries, funding becomes more expensive or harder to secure. That alone can influence production decisions. Many major funds now actively screen out or limit exposure to companies that don't show clear environmental transition strategies. That means oil producers are under pressure to demonstrate restraint, efficiency, and long-term sustainability planning. Cutting production can sometimes signal discipline, showing investors that the company isn't blindly chasing volume at the expense of profitability or climate risk. There's also shareholder activism. Investors today are more vocal than ever. They question executive decisions, demand emission targets, and push for diversification into lower carbon energy sources. Most corporate leadership teams have to balance market demand with shareholder expectations. And when stock prices are tied to investor confidence, maintaining that confidence becomes critical. For Canadians with retirement savings, pensions, or mutual funds invested in energy companies, these pressures directly affect portfolio performance. So while it may look like a purely industrial move, production cuts can reflect financial strategy as much as operational necessity. The energy business isn't just about oil rigs anymore. It's about capital flows, public perception, and long-term positioning in a rapidly evolving market. We break these stories down because surface headlines never tell the full story. Now we want your take. Are investors steering Canada's energy future more than politicians are? Drop your perspective below, and if you appreciate the effort we put into every video, tap subscribe. It's one click that keeps this research coming. Number 6. Political uncertainty is freezing long-term planning. Energy projects are not short-term ventures. They require years of planning, billions in investment, and long-term policy stability. But when the political landscape becomes uncertain, companies often hesitate, and sometimes they pull back entirely. That's exactly where Canada finds itself today. Energy policy in this country has become deeply tied to political cycles. Federal and provincial governments often clash over environmental rules, pipeline approvals, taxation, and emissions targets. Each election brings the possibility of policy shifts. For corporations making 10, 20, even 30-year investment decisions, that unpredictability creates risk. Imagine committing billions to expand production, only to face new regulations, higher taxes, or stricter emissions caps a few years later. That kind of uncertainty can make even profitable projects look unstable. When stability disappears, companies adopt a defensive posture. Scaling back production can be a way to reduce exposure while waiting for clearer signals from policymakers. There's also the broader political messaging. Public debates around fossil fuels have intensified. Energy companies often find themselves at the center of national conversations about climate change, affordability, and economic identity. When rhetoric heats up, corporate leaders must weigh reputational risk alongside financial calculations. For workers in energy-producing provinces, political instability can translate into hiring freezes, delayed expansions, or reduced output. For consumers, it can contribute to supply fluctuations and price volatility. And for investors, it adds another layer of unpredictability. In a sector where long-term certainty is crucial, even small policy doubts can have large consequences. When politics becomes unpredictable, our production decisions often become cautious. We put serious effort into unpacking the forces behind these decisions. Now we're handing the mic to you. Is political uncertainty hurting Canada's energy sector? Share your thoughts below, and if you value this level of analysis, hit subscribe. It's just one click, but it helps us keep delivering content like this. Number 7. Rising operational costs are eating into profits. Beyond politics and global trends, there's a more immediate pressure squeezing the industry: rising operational costs. Producing oil, especially from complex sources like oil sands, is not cheap. It requires advanced equipment, skilled labor, constant maintenance, and massive energy input. When costs rise across these areas at the same time, profit margins can shrink quickly. Over the past few years, our inflation has pushed up the price of nearly everything: steel, machinery parts, fuel for operations, transportation, and even insurance. Labor shortages in specialized trades have also driven wages higher. While higher wages are good for workers, they add another layer of expense for companies managing large-scale extraction sites. Then there are supply chain disruptions. Delays in equipment delivery or maintenance parts can slow production schedules and increase downtime. When projects are delayed, costs compound. What was once a stable, predictable operation can suddenly become more expensive to maintain. For a company evaluating its bottom line, the equation becomes clear. If the cost to extract each barrel climbs too high relative to global oil prices, scaling back production may make financial sense. Producing less can sometimes protect overall profitability rather than pushing full capacity at thinner margins. For everyday Canadians, and these rising operational costs can quietly translate into broader economic effects. When companies tighten spending, contractors feel it. Local businesses that depend on energy sector activity feel it. Provincial revenues can fluctuate as production changes. At the end of the day, oil production isn't just about how much sits underground. It's about whether it can be extracted efficiently and profitably. And when costs climb faster than revenues, tough decisions follow. And we dive deep into these stories because the real reasons are never simple. Now we want to hear from you. Are rising costs forcing smart business decisions or exposing bigger problems? Drop your thoughts below, and if you appreciate the work behind this channel, hit subscribe. It's one quick click that makes a real difference for us. Number 8. Global competition is getting fiercer than ever. Canada doesn't operate in an energy bubble. Oil is a global commodity, and that means competition is intense. Countries like the United States, Saudi Arabia, and other major producers can increase or decrease output strategically. And when they do, it directly impacts global prices. For Canadian producers, this creates constant pressure. The United States, for example, has dramatically expanded its shale production over the past decade. Non-American producers can often ramp output up or down relatively quickly compared to oil sands operations, which are more complex and capital-intensive. When U.S. production rises, global supply increases. And when supply increases faster than demand, prices fall. At the same time, major OPEC producers have the ability to influence markets through coordinated production decisions. If they flood the market, prices can drop sharply. When prices fall, higher-cost producers feel the squeeze first. Canadian oil sands production tends to be more expensive than some conventional fields in the Middle East. That means during price downturns, Canadian companies may have thinner margins. For a company like Imperial, cutting production can sometimes be a defensive move, choosing not to oversupply a market that's already saturated. Instead of competing aggressively in a low-price environment, scaling back can protect long-term financial stability. For Canadians, a global competition affects more than just corporate earnings. It influences national export revenues, currency strength, and job stability in energy-dependent regions. The world's oil chessboard moves fast, and Canada must constantly adjust its position. In a market where competitors can change output overnight, strategic restraint can sometimes be just as powerful as expansion. We put real time and research into breaking these global forces down. Now we want your voice in the discussion. Is Canada losing ground in the global energy race? Share your take below, and if you value the effort behind this channel, hit subscribe. It's one simple click that keeps us going. Number 9. Strategic production cuts can actually drive prices higher. Here's something most people don't immediately realize. Sometimes cutting production isn't a sign of weakness. It's a strategy. In global commodity markets, supply and demand determine price. When supply tightens, prices often rise, and for oil producers, higher prices per barrel can sometimes outweigh the impact of producing fewer barrels overall. If markets are oversupplied, prices drop. When prices drop too low, profit margins shrink fast, especially for higher-cost producers. By reducing output, companies can help stabilize or even push prices upward. It's a calculated move. Produce slightly less, but sell at a stronger price. In certain conditions, that trade-off can improve overall revenue. We've seen this strategy play out globally before. Coordinated production cuts by major oil-producing nations have often led to price rebounds. While Imperial operates independently, it still understands global market psychology. Investors react to supply signals. Traders respond quickly. Even the expectation of lower output can influence pricing trends. For Canadians, this kind of move can feel frustrating at the pump. If reduced supply contributes to higher global prices, fuel costs may edge up. But from a corporate standpoint, maintaining price strength can preserve jobs, shareholder returns, and long-term project viability. And the key question is whether this production cut is reactive, responding to external pressures, or proactive, designed to influence the market. In the world of energy economics, perception matters almost as much as production volume. So what looks like a retreat might actually be positioning. And in volatile markets, positioning can determine who survives the next downturn. We put real effort into uncovering the strategy behind these moves. Now we want your honest opinion. Is this smart market positioning or price manipulation? Drop your thoughts below, and if you appreciate the work that goes into every video, hit subscribe. It's one quick click that helps us keep delivering. Number 10. The long-term energy transition is forcing a strategic pivot. Beyond all the short-term pressures, politics, costs, competition, there's a much bigger shift happening in the background: the global energy transition. Around the world, governments and corporations are investing heavily in renewables, hydrogen, carbon capture, and alternative energy technologies. And this isn't just a trend, it's a structural transformation that could redefine how energy is produced and consumed over the next several decades. For traditional oil producers, this creates a difficult balancing act. On one hand, oil still powers transportation, manufacturing, aviation, and countless everyday industries. Demand hasn't disappeared. On the other hand, long-term forecasts increasingly show a gradual shift toward lower carbon systems. Where companies that ignore this shift risk becoming outdated. Companies that adapt too slowly risk losing investor confidence. Cutting production today could be part of a broader strategic pivot. Instead of aggressively expanding oil output, firms may redirect capital toward improving efficiency, reducing emissions, or investing in new technologies. It's about survival in a changing landscape. The goal isn't just to maximize next quarter's earnings. It's to remain relevant 20 years from now. For Canada, this transition raises difficult questions. Can the country remain a global energy leader while meeting climate goals? Can energy-producing provinces diversify without economic disruption? And how quickly should this transformation happen? This production cut may not just be a reaction to current conditions. It could signal a deeper recalibration, a recognition that the future of energy will look different from its past. And when industries evolve, the entire country feels the shift. We spend hours connecting the long-term dots so you see the full picture. Now we'd love to hear your perspective. Is this a smart transition move or a risky retreat? Comment below, and if you value the effort behind these deep dives, hit subscribe. It's just one click, but it truly helps us keep going. When you step back and look at the full picture, this isn't just a routine corporate adjustment. It feels like a turning point. One production cut has exposed pressure building from every direction. Regulations tightening, carbon costs rising, investors demanding change, global competition intensifying, and the long-term energy transition accelerating. None of these forces operate alone. They intersect, and when they collide, major decisions follow. For workers in energy-dependent regions, this moment carries uncertainty. For policymakers, it raises hard questions about balancing economic stability with environmental ambition. For everyday Canadians, it may show up subtly in fuel prices, inflation, job markets, and even retirement portfolios. What happens in boardrooms and government offices doesn't stay there. It flows outward into households across the country. But here's the bigger issue. Canada's identity has long been tied to natural resources. Only oil has funded infrastructure, social programs, and economic growth for decades. Now the country faces a delicate balancing act. Move too slowly and risk falling behind global climate expectations. Move too quickly and risk destabilizing key industries. So is this production cut a warning sign, a strategic recalibration, or the first visible crack in a much larger transformation? One thing is clear. The decisions being made today will shape Canada's economic direction for years to come. And whether you work in energy or not, this story affects you more than it might seem at first glance. The real question now isn't just why production was cut,